Hello everyone, I hope so you will be fine. So today we are going to discuss consolidation accounting. So please remember when consolidation accounting is required. So when one entity controls another entity. So in that scenario, so the controlling company, I mean to say the parent company is required to prepare consolidated financial statement. So here, let me give you example here. For example, we have a company A. Company A is going to acquire, or the company A has acquired more than 50% of voting rights. Voting rights mean to say common stock, outstanding common stock of company B. So in this transaction, company A is called a parent company and company B is called a subsidiary company, because here company A is having more than 50% of outstanding voting rights of company B. It means company A has a control over the company B. So guys, whenever one entity has control over the other entity, so in that scenario, consolidated financial statements are required. Now we need to understand what is the definition of control. So guys, control mean to say it is the direct or indirect ability to determine the direction of management and the policies of the investee. Like in simple words, when one company is in a position to direct the activities of the other company, it means the first company is having the control over the other company. And normally, control is achieved when we acquire more than 50% of outstanding voting interest or voting rights of the other company. So now guys, here we let's now understand the definition in the sequence. So the first definition we are discussing here, a business combination. What is business combination? Business combination, actually it is a transaction in which an acquirer means to say the company that is going to acquire the outstanding voting interest of other company. So business combination is a transaction in which an acquirer obtains control of another business. So this is called business combination. Like simply as I gave you example, if A is having a control over B, so this transaction is called business combination, and company A is called parent company, because parent company is a company that is having a control over the other company, and company B is the subsidiary company, because the subsidiary company is the company that is controlled by the parent company. And I already told you, control means we have a direct or indirect ability to determine the direction of management or the policies of the investee. So for example, let me give example. For example, if company A can set the dividend policies of the company B. For example, company let's you may influence or may decide the dividend policy of company B, that how much company B can pay the dividend. It means we have a ability to determine the policies of the investee, right? It means B is controlled by A. Okay. Then guys, when we prepare, now let me give you first examples here and other examples for voting rights, and then I'll explain this note. Okay. So here we go, guys. Here we have an example. For example, here we have a S company. S company, let's assume hold 85% of voting interest of B company. It means here S company is having a direct interest in B company, because S invested or S company has acquired 85% of outstanding voting rights of B company, right? So it means here S company is the parent company and B company is the subsidiary of parent, right? Or subsidiary of S, right? So here, what I told you, S is the parent and B is the subsidiary here. Now, and S is having a direct control in B, 85% of voting rights. Now, but if you look at here in the next transaction, what this says, so S company, which is parent company, is having 85% of direct voting rights in the B company, but the B B is having 60% of voting rights in the W company. So this is the scenario. S is having a 85% interest in B, and B is having a 60% interest in W. Now, so please remember, as we know it is the parent company, and B we know it is the subsidiary sub company of the parent company, right? But now the point is that what about this W? Is this W is the subsidiary of this parent company? So answer is yes, because S S which is the parent company is controlling the B company, and B company is the parent company of W. In simple word, if S is having a control over B, so it means S is having a control over W also through the B. So this is what is called group. I mean to say, okay, it means here you can say this S which is parent company, this Berg which is subsidiary one, the W which is subsidiary two. So it is considered as a one group, and this whole group will prepare consolidated financial statement. Okay, and consolidated financial statement is prepared by the parent company. Now this was the example of, we can say here, so this S is having direct interest in B, but S is having a indirect interest in W, right? But W is also subsidiary of this S, and B is also subsidiary of this S. Now if you look in the another structure, so here we have a Lisa company. Lisa company is having a 45% of M company. It means M company is the subsidiary one, right? And this Lisa company is the parent company. Understood? Now, please remember here we have a M company is having a 40% of in the D company. Now, there is another thing. It means M is having 40% of voting interest in D, but Lisa company also having a 30% interest in D. So now, please, if it means we can say here Lisa is having interest in D. How much? 40% here plus 30% here. So total they are having how much? 70% of voting interest. So, but this 40% is the indirect interest, and this 30% is the direct from Lisa point of view, because Lisa is having 40% indirectly in the D through the M, okay, through the mic. But Lisa also having a direct interest into D. So in this scenario also, Lisa plus Mike plus D will be considered as one group, and Lisa company will prepare the consolidated financial statement. So there are several forms of direct and indirect controls are there, especially indirect controls, but that much detail is not required for CMA students. So mainly in your exam question, they will tell you that we have a parent and we have a subsidiary. But I told you, so we may have a direct interest also and indirect interest. Now, guys, now please remember here, let's assume we have a one parent company and one we have a subsidiary company. Okay, so usually at the end of year, parent will prepare its own individual financial statements, and subsidiary will prepare its own individual financial statements, and then the parent company is required to prepare the consolidated financial statements also. Understood? And why we prepare consolidated financial statement? So the reason is, so there are two types of concept is there. One is called legal concept. Second is called substance, economic substance concept. Okay. And that is also called economic substance over form, a substance over form. So we have a legal form and we have a substance form. So please, guys, what is legal? Legal form is that this parent company and subsidiary company, these are two separate legal entity. But economic reality, which is the substance over form, okay, the substance or the economic reality is that this subsidiary we can treat as a one department of parent. Okay, as a one department of parent, because parent company is having control over subsidiary, so we can treat this subsidiary as a one department of parent. And due to the substance, due to the economic reality, we are required to prepare the consolidated financial statement. So this is what is the point here which I was trying to tell you, that I'll explain it. So they are saying consolidated statement present amounts for the parent and subsidiaries if they were a single economic entity. Okay, and here is also maybe note is written somewhere here, that why consolidated financial statements are required. Okay, so in the strict legal form, as I told you, P and S remain distinct because in legal form these are different companies, but in economic substance, in economic reality, so they can be recorded as a single unit. Single unit means a group, so that is why consolidated financial statements are required. Please remember we have a two consolidation models. Two consolidation models. Consolidation model means a when consolidate you can do the consolidation. The first model is called voting interest entity model. Voting interest entity model VOE. Voting interest entity model. Okay. If voting interest and entity model is there, it means consolidation is required. So what is voting interest entity model? I'm explaining first model. Voting interest entity model. Voting interest entity model mean to say the parent is having a more than 50% of voting interest into another company. So due to this more than 50% of voting interest, okay, consolidation is required. So this is what is called voting interest model. Okay, voting interest entity model, right? And there is another model in which consolidation is also required, although in other model you will not have more than 50% of voting right, but still consolidation is required. So and the name of the second model, that is called what? Variable interest entity model. VIE, variable interest entity model. So guys, please, this is the second model is explained here. So in this model, although one company does not have more than 50% of voting rights into other company, but still the first company is controlling the other company. Still the first company is having the ability, direct or indirect ability, to set the direction of the management and policies of the investee, even though you don't have more than 50% of the voting rights. So that is called variable interest model. So usually how variable interest model is achieved? Okay, variable interest entity model, how it is achieved? So usually it is achieved through the contract. For example, let's say we have a company A and company B. Through the contract, company B has given the controlling authority to the company A, right? So in that scenario, A will be considered as parent company and B will be considered as a subsidiary company, and then consolidated financial statements are required. Okay, so that is variable interest entity model. And please remember, in variable, here we go, let's have a look. So they're saying that the controlling interest is generally arranged, like parent is controlling the subsidiary, but this is arranged through the contract, not through the direct ownership. Not through the direct ownership means say maybe the parent is not having more than 50% of the voting right, but still parent is having a control over the subsidiary. And also remember here, controlling entity means a parent company. Okay, controlling entity absorbs the losses or benefits from the controlled entity. So you will take their losses and benefits both. Okay, you will absorb, right? So this is what is, if this scenario is there, like through the contract, if control is passed, that is called what? Variable interest model and variable interest entity model. And even if you have a voting, okay, interest entity model or variable interest entity model, in both scenario, consolidated financial statements are required. Now, now the point is that here we have a small note why consolidated financial statements are required. Why? So actually, for example, if parent is controlling subsidiary, so technically in legal term, parent is a separate legal entity and subsidiary is a separate legal entity in legal term. But if you will look into the substance over form, or if you will look the economic reality, okay, of this company, so we can say in economic reality, which is also called substance over form. Okay, in substance form. Okay, so in economic reality we can say the S is the one department of P, and this department is managed by P, right? So that is why not legally, due to substance over form, due to economic reality, so we prepare the consolidated financial statement, because technically we see the subsidiary is one of the department of the parent company, right? So this is what is written here. So in strict legal term, means say in legally, so P and S, they are two separate companies. But if you will look the economic reality or the substance, okay, so then we can treat both companies as a single unit, and we assume the subsidiary is the one department of parent which is managed by the parent, right? So please, this is what I told you. Due to the economic reality, we prepare the consolidated financial statements. Now, next point I'm going to explain. So guys, please remember, first thing, let me tell you here. Let me start with the help of example, and then we'll go through. For example, let's assume today is the, let's assume 1st January 2024. I'm just assuming this is our start of the accounting period, and our accounting period ends on 31st December 2024. Let's assume at this date, just assuming at this date, P has acquired subsidiary. So we have a parent and subsidiary, and at this date, a business combination happened, a financial transaction happened in which parent acquires the subsidiary and parent acquires a voting interest in the subsidiary, right? Now, please remember, it means at this date, for example, parent acquires, let's assume 60% of voting rights of the subsidiary. So it means this is called date of control. Date of control, right? Like this is the date at which control is achieved. Please remember, at this date, when control is achieved, so we always calculate the goodwill. Okay, first we calculate the goodwill because we acquire the other business and we have to calculate the goodwill, or we have to calculate the gain on bargain purchase. Okay, so this is what I'm going to show you. And to calculate the goodwill or gain on bargain purchase at the date of control, we always follow acquisition method. What do we follow? Acquisition method. Actually, acquisition method guide us, okay, like which values we have to take, and okay, how to take. This is what is the acquisition method. So please remember, first I told you at the date of control. What is the date of control? The date at which control is achieved. At that date, we have to calculate goodwill, or we have to calculate a gain on bargain purchase. Okay, and we follow which method to calculate the goodwill or gain from the bargain purchase? We always follow acquisition method. And now, what is acquisition method? So acquisition method is very simple, that I'll explain, because the same thing we will follow in the goodwill calculation or in the gain on bargain purchase. But first, let me explain theoretically, then I'll show you some calculations. So here we go. So they're saying acquisition method is what? They're saying that a business combination. Obviously, I told you business combination is the transaction in which acquirer obtains the control of another business. This is what is business combination. So they're saying business combination must be accounted for using the acquisition method. As I told you, acquisition method we use at the date of control to calculate the goodwill or the gain from bargain purchase. Now, what is acquisition method? So in acquisition method, we have to do this thing. Number one, we have to determine the acquirer and the acquisition date. So we need to know first who acquired the other business and what is the date, okay, at which control is achieved. So these two things we need to identify. Who is the acquirer? What's the acquisition date, right? Acquisition date means when control is achieved. Number two, we have to look, we have to recognize, we have to identify, okay, at acquisition date. Like for example, add this is the acquisition date. Add this date, we need to identify the fair values. We need to identify, or we need to determine the fair values. Fair values of what? Identifiable assets of subsidiary. Okay, identifiable assets of subsidiary, because we are acquiring obviously the business, right? So we need to know which assets are identifiable, or we need to identify the fair value of identifiable assets acquired, right? Identifiable asset means that these are usually those assets which can be separately bought or sold, right? So we need, guys, we need what? At acquisition date, we need fair value of the identifiable asset. We also need fair value of the liabilities of the subsidiary, and plus we also need to know the fair value of non-controlling interest. Non-controlling interest, I told you, for example, if you acquired 60%, so remaining 40% is your non-controlling interest, and this 60% is controlling interest. So we need a fair value of three things. Which three things? Fair value of assets of subsidiary, fair value of liabilities of subsidiary, and fair value of non-controlling interest in the acquiree or in the subsidiary. And then the result of these things, by the way, the result of these things be the goodwill. Result would be the goodwill or from gain from bargain purchase. So please remember, I'll show you, don't worry, how to calculate goodwill or bargain purchase, because we'll use the same data to find out goodwill or the gain from bargain purchase. So I have a question here, or a small note, you can say. Please remember, if you once we will calculate the goodwill, for example, if there is a goodwill, so goodwill will be shown in consolidated balance sheet only. Okay. Consolidated don't show in the individual balance sheet. It will be shown only in the consolidated balance sheet. But if it is a gain from bargain purchase, gain. So because we'll apply the formula, the result would be either goodwill or result would be gain from bargain purchase. If the result is gain from bargain purchase, please remember this figure will be presented in the consolidated income statement. Okay. Income statement. Goodwill will go to the consolidated balance sheet. Okay. Balance sheet, it's also called statement of financial position. And if it is a gain from the bargain purchase, it will go to the consolidated income statement. So now by applying acquisition method, so I'm going to show you how you would calculate goodwill or gain from the bargain purchase. Okay. So here we go. So let's understand the formula. So with the help of, so this is actually, guys, the formula of calculation of goodwill or of the calculation of gain from bargain purchase. So please remember, first of, as I told you, add the date of control. So first of all, we need, okay, we need what? We need, this is the formula I'm just explaining, then I'll go through the example, don't worry. So first of all, we need consideration transfer. I'm assuming, for example, I have purchased, let's assume I have purchased 60%, let's assume, of voting rights of other company. And for that 60%, so I have taken or I have given 192,000 cash. Okay. Sometime maybe I will acquire other business, but I will not give cash. Maybe I can give my stocks to acquire their stocks. So if I'm giving my stocks, so I need to take fair value of stocks given as a consideration transferred. Okay, consideration transfer means what you have given for the acquisition percentage. So let's assume we have given $192,000, and then we will add here in consideration transfer, we will add here fair value of non-controlling interest. And in my example, whatever I'm giving you right now, for example, it is 40%. And this fair value of non-controlling interest will be given in the question. Don't you worry. You don't need to worry about it. Okay, so it will be given. So let's say it is given as 48,000. And then example I'll read later. Okay, I'm just telling you formula. Formula is what? Simply, then what you have to do? So these two values we will add, no, consideration transferred plus non-controlling interest fair value. Okay, we need fair value of everything, by the way. Okay, of consideration transfer. If you're giving shares to acquire shares, if you're giving cash, then cash, whatever you're giving, that is the fair value. But if you're giving stocks to acquire the stock of other business, so whatever stock you are given, so that you have to take the fair value of those stocks given, that will be your consideration transfer plus non-controlling interest at fair value. And then from there you will deduct deduct fair value of net assets acquired. Net asset, equity acquired. And usually how net asset is calculated, asset minus liability, right? And assets we have already taken identifiable assets, and liabilities we have taken whatever liabilities you are assuming or you are taking up of the subsidiary. So assets minus liabilities is always equity, right? So this equity is also called net asset. So that is why we will deduct here the fair value of net assets. Net asset means of equity acquired. And if equity is straight away not given, you can take asset minus liability. Okay, fair value. So if you will, this is your net asset value, right? So this value minus net asset value. If answer is positive, this is your goodwill. If this answer is negative, this will be your gain from bargain purchase. Okay, so let's go through now the examples. Now I'll solve the example and I'll show you few different things with the help of examples. Okay, so a few points I will explain. So here we go, guys. For example, they're saying entity C. I need concentration here, guys. Entity C acquired 80% of outstanding common stock of entity D. So by the way, 80% is the controlling interest and 20% will be what? Non-controlling interest, right? Okay, but sometime in your exam question, he may tell you that parent acquired 100% of subsidiary or all stocks of subsidiary. In that scenario, no NCA will be there, right? Non-controlling interest because you acquired 100%. But if you acquired less than 100 but more than 50, then NCA percentage will be there. So here we go. Reading example once again. Entity C acquires 80% of outstanding common stock of entity D for 192,000. Okay, this is actually for 80% you have paid 192,000 and entity D's acquisition date, fair values of identifiable assets and liabilities were $350,000 and $140,000 respectively. So this is the value for asset, this is the value for liability. So the acquisition date fair value of NCA was 48,000 because NCA percentage is 20%. It is 48,000. The goodwill or the gain from bargain purchase, how you will calculate. So first of all, we will take consideration transfer. This is for 80% now. 192,000. Then you have to take fair value of non-controlling interest. This represents 20%, 48,000. If you will add these two value, so it is going to be 240,000, right? This 240,000 represents the value of 100% business, right? Because this is 80%. First figures and this is the 20%, so total value is 100%. Now we'll deduct here fair value of net assets acquired. Net asset is what? Assets minus liability. So assets minus liability and assets value is 350, liability value is 140. So 350 minus 140, so net asset or equity is 210,000, right? So we'll take 240,000 minus 210,000. So this answer is positive, right? 240 minus 210. So answer is positive. So this positive is goodwill. So what is goodwill? Because you are paying over and above, for example, okay, the value of asset. So that is your goodwill. So goodwill is your intangible asset. And if there is a goodwill, so this goodwill will be shown in the, consolidated balance sheet. Okay, now same example we are continuing. I'm just changing one figure and see the results. Let's assume, still I'm assuming same thing. Okay, same example we are taking. Only one thing we are changing. We are saying, for example, C acquired 80% of common stock of D for 192,000 and fair value of NC is 48,000 and fair value of asset, this value, this figures we are changing now. Now we are assuming this figure is 400,000 asset and liabilities are the same. 140,000. So how would you calculate goodwill or gain from bargain purchase? So I'm just showing you here. So first of all, you will take consideration transferred. Consideration transferred. This is represents 80%. It values $192,000 plus fair value of NCI. Okay, so which is 48,000. So total value is 240,000. Okay, then from there we'll deduct here less fair value of net assets acquired. Net asset acquired. Net asset is what? Assets minus liability. So asset was 400,000 now in my example. Liabilities are 140,000. So net assets are 260,000. This I have to deduct. Okay, now 240 minus 260. So there will be 20,000 negative. This 20,000 negative is called gain from bargain purchase because whatever you are paying, let's assume this is what you have paid for this asset. So you have paid less now. Okay, in goodwill you paid more, but here you are paying less, let's assume. Okay, so that's why it's called gain from bargain purchase. And this gain from bargain purchase, 20,000 negative, you will reflect in the consolidated income statement. Okay, I hope it is clear. Now, guys, please remember Sometimes. So this is little bit another type of example and see how things are different. Sometimes, guys, in exam question, please remember, he may tell you that assets or liabilities. For example, we know assets, right? Assets of inquiry minus liabilities of inquiry equals net assets. So we need net assets of subsidiary, right? Sometimes he may tell you that carrying value of asset is equal to the fair value of asset. Then there is no adjustment, right? Say, but if he told you that carrying value is less than fair value, or I hope so you are understanding what I'm telling you. Sometime, in exam question, he would say this way, he would say, whatever assets you have acquired, their carrying value is exactly equal to fair value. Then there is no adjustment which we need to do in the net assets. Okay. But sometime, what if he told you, for example, he told you, let's assume in this scenario, we required no adjustment. Okay, no adjustment. But if he told you that fair value of some asset is greater than carrying value of assets, so it means whatever the difference is there, so that difference will be added to the net asset answer, net asset. Okay, and sometimes he may tell you that fair value of certain asset is less than carrying value of certain assets. Fair value is less than carrying value. In that scenario, again, we need the difference, and that difference we will deduct, okay, from the net asset. This is what is the adjustments of assets. Sometimes same adjustment he may give you regarding liability, but you have to think this way. Sometimes he will tell you whatever liabilities you have acquired, so their carrying value equals to the fair value. So very good. In that scenario, again, no adjustment is required. But sometime he may tell you that fair value of liability is greater than carrying value. So you have to take first difference, whatever the difference between carrying value and fair value. So this difference you will deduct. It's totally opposite to the asset. So you will deduct from the net asset working, net assets answer. Okay. But if we told you that fair value of certain liabilities are less than carrying value, in that scenario, opposite to the assets, what you have to do? You will again take the difference of fair value and carrying value. This difference you will add to the net asset. Okay, guys, so these adjustments might be given. I'll show you now. What I told you guys, I told you, please just go through this one more time. What I have said, I have told you if assets are there, and he told you carrying value equals fair value, no adjustment is required. But if some assets fair value is greater than carrying value, we'll take the difference. The difference will be added to the net assets, because we are taking net asset at fair value, and fair value is more, so that is why we have to add this difference to the net asset. But if fair value of certain asset is less than carrying value, then we'll take difference will be deducted from net asset. And similar way for liability, if carrying value equals fair value of liability, no adjustment is required. But if fair value is greater than carrying value, so then this difference will be deducted from net asset. If fair value of liability is less than carrying value, then this difference will be added to the net asset. Please remember this thing. Now I'll show you example. See again, because if we want to make the goodwill or gain from bargain calculation technical, so he may give you these kind of adjustments. Here we go. Let's have a look. They're saying that it's another example. I hope so you can read it. So they're saying P issued stock with the fair value of 120,000 to acquire all of outstanding stock of S. Actually, see, here P is not giving cash. P is giving his stocks to acquire the stock of S. Here P is the parent company actually, and S is the subsidiary company, right? P acquired all stocks. All stock means it means there is no NCI, because all means you bought 100%. So there is no NCI. Okay, we paid for 100%. How much? 120,000. So let's start goodwill working also. So for goodwill working, guys, for goodwill working, we need first of all consideration transferred, and we acquired here 100%. Obviously, for 100%, we gave the stocks, and the fair value of the stocks is how much? 120,000. So we'll take 120,000. And now from there, because you don't have NCA figure would be zero because you acquired 100%. And now this is total is 120,000. Now, guys, we will deduct here fair value of net assets acquired. This is what I need. And for that, we have assets minus liabilities equals net assets. Okay, so here we go. So now let's continue with the question. They're saying that the carrying amount of net asset straight away is given. Asset minus liability, answer is given 100,000. Okay, so this is the carrying value. I'm just writing it here. In the inner column, net asset figure is given as 100,000. Okay. So, but what he told you this carrying amount of, this is the net asset, right? 100,000. The carrying amount equals the fair value. Okay. Of all S net asset except they are telling you there is a set, you mostly carrying value equals to the fair value except what? Except the fair value of inventory and property, plant and equipment. They are saying there are two items. One is inventory and one is PP. Their fair value exceeds their carrying amount by 4,000 and 10,000. This 4,000 is for inventory and 10,000 is for PPE. It means I told you if it is asset, yes, it is asset because it is inventory and PP. And if assets fair value is greater than carrying value, yes, here fair value is greater than carrying value. Fair value how much? 4,000 plus 10,000. This is greater than carrying value, he told you, right? He told you fair value of inventory and PPE exceeds their carrying amount. So it means if it is more, it means if it is more than 14,000, right? Because 4,000 for inventory, 10,000 is for PP. So fair value exceeds 14,000 than carrying value, right? So now this 14,000, I told you whenever fair value is greater than carrying value, this difference will be added to the net assets. So what was the net asset figure? Net asset figure was 100,000. Now you will add 14,000 into that. So it means your total net asset will be 114,000, which you will deduct from this figure. Okay, so net asset was 100,000. Now 14,000 I will add into that. So my net asset will become 114,000. Now if I'll deduct 120 minus 114, now if answer is positive, yes, it is positive by 6,000. So this is goodwill, and goodwill will be presented in the consolidated balance sheet. Okay, our consolidated statement of financial position. Is that clear, guys? So this I have already explained the solution for this example. I hope so it is clear. So now we have a note. This note I have already told you that goodwill we always record in consolidated balance sheet, and gain from bargain purchase we always record in consolidated income statement, right? Because positive answer of this equation is goodwill, negative answer of this equation is gain from bargain purchase. So now we have some other, this is theoretical points only, guys, I'm explaining here. So this, they may test in your exam question, you should remember. Sometime, guys, please. So I'm dealing here, this is like a note you should understand for your exam. Note is what? So costs associated with business combination. There are three types of cost is there, or generally there are two types, but I'll make it three. Number one, acquisition related cost. Acquisition related cost is what, sometimes you are hiring agent who will find out acquiry for you, right? You will pay commission to them. Maybe you will pay some professional or some consultancy fee, maybe some finder fee, who will find a target company for you, which you will acquire, and some general administration cost, all acquisition related cost. So these costs we always record as expense as incurred. Okay, as expense as incurred. Okay, please remember acquisition related cost like finder fee, consultancy charges, professional charges. Okay, so this you will record as expense. And please also remember, sometime we issue our stock to acquire the stock of other companies. So if we issue our stock to acquire the stock of other company. So when we issue our stock, we may have some issue cost on that. Issue cost is what? Maybe underwriting cost, maybe you are, dealing with the banks, bank is charging something, legal cost, accounting, tax, registration, etc. So please, all issue cost which is relevant to the equity, issue cost of equity, we always pay from additional paid in capital. Where we pay? From additional paid in capital. Okay. Entries, just I'm explaining here. I just told you that acquisition related cost you will record expense. Entries I'll show you, don't worry. Okay. And if issue cost is relevant to the equity, so that will be paid from additional paid in capital. Okay. And now sometime maybe you may issue bonds. Okay. You may issue bonds of your company and you will get a cash, and that cash maybe you will use to buy the stock of other company. Okay. And when you issue the bonds, there could be a issue cost also. Now I'm talking about debt issue cost, because bonds are debt. Debt issue cost is always deducted from the carrying amount of the debt in the balance sheet. So these three treatment you have to remember. Okay. Acquisition cost is recorded as expense. Equity related issue cost is paid from additional paid in capital or deducted from additional paid in capital. And debt issue cost is deducted from carrying amount of debt in the balance sheet. Okay. So we have a small example. Just they will, in your CMA exam, they will test only theoretical things I told you. Okay. That's theoretical things from this. Okay. But here we have a small example. Let's have a look. So they're saying on Okay, they're saying on January 1, year 1, Lip Company issued 100,000 shares of its par value common stock and transferred 300,000 in cash in exchange for all of our company's outstanding common stock. Actually, what happened here, guys, Lip Company acquired our company, okay, and we give some stocks, our stocks, and we give some cash. Then they're saying to finance this acquisition, that how you got the cash to buy this company. Lip issued bonds with the par value of 300,000. We issued bond. This is debt. And the following costs in relation to the acquisition were incurred by Lip. So bond issue cost is 15,000. Printer's fee of $10,000 for stock certificate. This is equity issue related cost. Finder and consultancy fee. This is acquisition related cost. What you will do? First, we are dealing with the First, we are dealing with this cost, debt issue cost. So this 15,000. So we'll debit the debt issue cost, we'll credit the cash, and this 15,000 will be deducted from carrying value of debt in the balance sheet, will be deducted. Okay. Then what? This fine printer's fee. But guys, I'm not explaining in much detail because we need to unamortize that issue cost. Okay. So, but just you have to remember it is deducted from carrying amount of the debt for the CMA student. It's enough. Then printer's fee, $10,000 for the stock certificates. So this is equity related issue cost. It is always paid from additional paid in capital account, or it is deducted from additional paid in capital. And what is the entry? You will pass this entry. Debit additional paid in capital, credit cash. And the third cost is finder fee or consultancy fee. This is acquisition related cost. This is recorded always expense. So what entry you will pass? Debit business combination expense, credit cash 40,000. Okay, guys. So this is what is how to deal with the issue related cost. Now I'm telling you here, very important note, but I'll explain little bit information, but please, this note is important. So being a candidate of CMA, you are not required to prepare consolidated balance sheet on your CMA exam. Even you are not required to prepare consolidated income statement. But then what is required for you? General understanding of consolidation is required. General, maybe theoretical things only. Okay. But I'll try to show you few calculations, whatever I can. So, but as I told you, for CMS students, you are not required to produce any balance sheet or any consolidated income statement. Okay. So now, guys, here, regarding balance sheet, I'll explain two things. Number one, how to prepare balance sheet at the date of acquisition. So because we are preparing balance sheet, okay, consolidated balance sheet. So consolidated balance sheet we can prepare at two different places. Number one, at date of acquisition. Acquisition means when control was achieved. At that day, how to prepare balance sheet, and then at the end of year, at year end. Second is at year end. In my example, our date of acquisition was 1st January, for example, 2024, and our year end is 31st December 2024. So the day when you acquire the business, at that day, how balance sheet is prepared, and then at the end of year how balance sheet is prepared. By the way, this is issued to the public, which we produce at the end of the year. Okay, but this is just we are learning the process, how we can prepare. If you want, how you can prepare the balance sheet at acquisition date or at the date of acquisition date. So this is what we are discussing here. So acquisition date balance sheet I'm explaining here. So in your book, mostly theory is written, but I'm showing you a few calculation how we can produce balance sheet at the date of acquisitions. Here we go, guys. So please remember, let's have a look. Very first step you have to do at the this all we are doing at the date of acquisition. All whatever steps we are doing today in today class, I'll finish only at the date of acquisition. What you will do next class, we'll see how to deal with the year-end consolidation. Okay. So as I told you many times, only general understanding is required. So date of acquisition. So step number one, what you have to do. So you have to determine the amount of goodwill or gain from bargain purchase. Okay, you have to calculate this thing first. Okay, which is the result of business combination, goodwill or gain from bargain purchase. And let's have a look. This is the example, for example, with us. For example, here we go. They told you on December 31, year one, P and S have the following condensed balance sheet. I'm assuming P is the parent, S is the subsidiary. So these are the current assets of parent of subsidiary, non-current assets of parent of subsidiary. These are the total assets. Then we have a current liabilities of parent of subsidiary, non-current liabilities of parent, and we don't have any non-current liability for subsidiary, equity of parent and of subsidiary, and this is total equity and liabilities. Okay, and we know assets are always equals liabilities and equity. Assets are always equals liabilities and equity. Okay, now so then this is not the complete question, so now we have to read further information as well. So then they're telling you on January 1, year 1, at the start of year. Okay, almost these dates are same, right? This is one day before, this is very next day. Okay, on January 1, year 1, we can say this is the start of next year. The P's borrowed, P parent borrowed $120,000. It's like a loan. They took a loan $120,000 on 5 years balloon note, that you have given something in writing and you have taken a loan of 120,000 and used the proceed, like they used this 120,000 loan to purchase 80% of outstanding common shares of S. It means our controlling percentage is 80%. So it means there is a 20% which is non-controlling interest, right? Then P had no prior equity interest, okay, in S. This is the only transaction. Assume. What do you have to assume? Assume that carrying amount of S assets and liabilities equal the fair value, except this, except we have to study. Except the fair value of land. Land is asset. They're saying fair value of land exceeds its carrying amount by 25,000. Very good. Okay, and he told you also assume that fair value of non-controlling interest is 30,000. So first of all, as I told you, step number one, at the acquisition date, because acquisition date is January 1, year 1, we acquired 80%. So at this date, very first thing, we have to calculate goodwill. And now see how goodwill is calculated. Very first thing, what you will write, I'm just telling you here. First, you would write it here. Consideration transferred. How much you transferred for 80%? We transferred for 80%, 120,000. Because he told you we use this borrowed amount to buy 80%. Okay. So then we need fair value of NCA, which is given here 30,000. So this is total value 150,000. Now, from there we have to deduct acquisition date fair value of net asset acquired. Fair value of net asset. For net asset, we need value of assets and value of liabilities, right? Okay, so we know net asset is what? Assets minus liabilities equals net asset. And net asset is also called equity. And because we need assets acquired or net assets acquired means of subsidiary. So why I should do here now assets and liabilities? Why I'm not taking value of equity directly of subsidiary? Right or wrong? Because assets minus liabilities equity. For example, let's here we have a equity value, right? This is subsidiary, right? This is subsidiary and equity value is 100,000. This is net asset. But if you want this way, assets minus liability, you can do this way. This is the assets 100. This is the asset of subsidiary, right? 120 is the asset. 120 is the asset. Liability is this one is the liability. This one is the liability of S. This section, highlighted section only. 20 and 0 because this is liability section, right? 20,000 0. So it is 20,000. By the way, equity is how much? Net asset is much, 100,000. So it is given here, right, guys? So equity is given. So why I am doing assets minus liability? Because I ultimately need equity. Equity value is given. So this is my net asset. But now there is adjustment. Net asset is 100,000. Net asset of acquiree I have to take. Now there is adjustment. He told you there is a land. Land is your asset. Land's fair value exceeds the carrying amount by 25,000. It means I told you whenever assets are there and their fair value is greater than carrying value. So the difference will be added to the net asset value. So what is the net asset? 100,000. I'll add 25,000, this difference. So my net asset will become 125,000. So this 125,000 I'll deduct, okay, from this 150,000, right? Because consideration transfer plus NCA, it was 150 minus net asset is 125. So 25 is positive answer. So this is going to be your goodwill. And goodwill will be reflected in the consolidated balance sheet, right? Understood? Step number one is done. What's the step number one? First step is what you have to produce calculation of goodwill or gain from bargain purchase. So this we have done. Step one is over. Understood? Now step two, what? What is step two? So step two, we have to follow now. Step two is what? We have to prepare the asset section of consolidated balance sheet. Okay, asset section. So asset, how you will prepare? So very simple. First of all, when you work with the non-current assets, first you have to work with the current assets. Okay, and simply you have to take current assets of parent plus current asset of subsidiary. This is what I'm doing at the date of acquisition only. So here we go. Parent current asset was how much? If you will move to the parent assets, current assets, parent current, this is current asset, right? Parent current asset is 140, subsidiary current asset is 40. So total 140 plus 40 is 140 plus 40 is 180,000. Then you have to prepare non-current asset section also, because asset section we are preparing, right? In asset section we have a current and non-current. And when you prepare non-current asset, first you have to take, this is non-current asset. First you have to take parent non-current asset plus subsidiary non-current assets. Okay, and along with this 180,000 and 80,000, we have to show goodwill also, and we have to show fair value adjustment also. So this is how it will be prepared. So first of all, we'll take non-current assets of parent, then we'll take non-current asset of subsidiary, then we'll take fair value adjustment, because fair value is more than carrying value. So if fair value is more, we'll add. If fair value is less than carrying value in assets, so we'll write this 25,000 minus. But here fair value is more than carrying value, so that's why 25,000 we'll write as a positive. And then we'll write here goodwill, which we have calculated 25,000. So this is consolidated non-current asset. Okay, consolidated non-current asset. Understood? So asset section is ready, right? In asset section, what we have done? For current assets, we have taken parents plus subsidiary. For non-current assets, we have taken, for non-current asset, we have taken parent plus subsidiary plus fair value adjustment plus goodwill. That's it. Okay. Two step is done. Step number 3, we have to prepare liability section also. Liability section. And for liability, same, we will write for current liability, we will write it here. Current liability will write parent plus subsidiary. Then for non-current liability, we'll also write parent plus subsidiary and plus any new liability if is there. Okay. So this is what we are going to do. So for current liabilities, first of all, current liabilities I'm dealing first. So what we'll do, we'll go to the balance sheet. We'll take, this is current liability. We'll take parent plus subsidiary. So 60 plus 20, 80,000. This is liability section. Current liabilities of parent, 60,000. Current liabilities of subsidiary, 20,000. Total consolidated current liabilities, 80,000. And for non-current liability, what I have to do? Again, for non-current liability, I'll take parent plus subsidiary. So parent is 100,000, subsidiary is 0. Plus this new loan I have issued, right? 120. So these three things I'll take. Non-current liabilities. Non-current liabilities of parent 100,000, non-current liabilities of subsidiary which is 0, and new non-current debt is 120. So this is consolidated non-current liabilities 220,000. Okay, guys. And then step number 4 is we have to prepare NCI values and equity section we have to prepare, right? NCI and equity. NCI value is given, right? It is given. Okay, NC value is given by the way. And now when we take the equity, okay, when we take the equity, so please remember in equity, we will not do this way. In equity, we will never do this way, parent plus subsidiary. No, we'll take only parent's equity because as a single entity, as a substance over form, because in consolidation, guys, when we prepare, we assume this is as a single entity, right? And when we uh, assume we are a single entity, so we cannot make investment in ourselves, right? I cannot buy my own stock, right or wrong. I cannot make investment in my own stock. So that is why when we present the equity section, right? So in equity section, we will record only parent's equity, not the subsidiary equity. This is the first reason. Okay, because we are a single entity. Second reason is that the equity of the parent, sorry, equity of the subsidiary, which we are not showing in the consolidation, is transferred to the goodwill calculation. We have done the goodwill calculation there. We have used the net assets, right? So this is what when we prepare the equity section. So this is how we'll take. So we'll take just go to the balance sheet first. We'll take equity when it comes to the equity, we'll take only parent equity. Don't take subsidiary equity, so which is 160,000. And then we'll take NCA values. Parent equity is 160,000. And then we'll write NCA value, NCA fair value. It was given in the question here. NCA figure is given here, right? Here. This NCA will take it, this figure. Okay. So now we can prepare acquisition date balance sheet. So this is how it will be prepared. So first of all, we'll write asset side. We have a consolidated current assets we prepared here. 180,000, right? This figure. And for non-current asset, we will write 310,000. We have a current assets. Then we have a non-current assets, 300 total assets. Then from liability equity side, we have a current liabilities, 80,000, non-current liabilities, 220,000. And then we have a equity, this figure, 160 and 30. Okay. So this is what we'll do. Consolidated current liabilities, 80,000. Consolidated non-current liabilities, parents equity, 160, NCI, 30,000. And this is consolidated total liabilities and equity, 490,000. And please remember, assets are equals liabilities plus equity, right? And this is a note just for your information. I don't think so they will test in the CM exam. It's called reciprocal investment. We know parents invested in subsidiary, right? Some, for example, 60%. Sometime maybe subsidiary may have invested in parents, let's assume 10% of stock. So this is called reciprocal investment. Okay, reciprocal investment. And this is also called intercompany investment. So this intercompany investment, because this is not intercompany, we will not treat, because we need this for consolidation. But this is reciprocal investment, and reciprocal investment must be eliminated. We don't show, okay? We don't recognize, okay? Must be eliminated, okay? And subsidiary shareholding in parent are treated as a treasury stock of consolidated entity, okay? So because it's like that I am buying my own shares, right? So this is treated as treasury stock of consolidated entity because no gain or loss on treasury stock transaction is recognized. So reciprocal investment have no effect on net income or retained earnings of the consolidated entity. Okay. So simply reciprocal investment must be eliminated. So this is not required how to eliminate, but just remember if reciprocal investment is there, so that will be eliminated. Understood, guys? So I hope so it is clear, guys. So this is small example for reciprocal investment. So they're saying assume that one on the date of acquisition, S held, S already held 1000 shares of P. S is subsidiary, P is the parent. So they have 1000 shares of stock. In preparing consolidated balance sheet, this holding of 1000 shares is eliminating by debit to the treasury stock. They will pass this entry debit treasury stock and credit to the investment. Okay, in P. So this will be the entry. But in simple, you have to remember this word. So this will be eliminated. Simply, they will not ask any counting entries. Okay, guys? Is that clear? So remaining how to prepare consolidated balance sheet at year end, that I'll cover in the next class. Thank you, guys. Thank you so much. If you have any question, you can ask.